tonight. Anglo American Platinum has reported a 19 billion rand plummet in its half-year profit. That's due to a decrease in overall PGM production and falling metal prices. The miner announced that headline earnings per share decreased to almost 29 rands per share, while net profit decreased to 7.9 billion rands. This follows a 29% decline in the price of the PGM basket and a collapse in the prices of rhodium and palladium. The decreased output caused by Eskom's load curtailment, which affected concentrators and smelters, made PGM production even worse. For more on this story, we are joined now by Amplats CEO Natascha Viljoen. Natascha, thank you very much for your time this afternoon. The mining sector is not enjoying the high commodity prices that we saw 3 years ago. How much of that decline can be attributed to this particular performance in this first half for Amplats?
Good evening, Xolani, and very good question. I think we need to consider the context of the periods we are comparing against. We came off 3 years of very high commodity prices. The plummet you referred to earlier is really only getting our basket price back in line with what's far more of a sustainable level of PGM prices. It is important to recognize that because we do see substitution and thrifting of our metal the moment the prices go too high, and that causes further instability in our markets, something that we do not want. So very much aware of the decrease to more normalized levels, and these levels are then obviously the levels within which we have to operate. We did have a bit of a double whammy in this first half because, as you commented, year on year we've also seen a reduction in performance. A big portion of that was absolutely planned and expected, and it is on the back of a lower grade area through which we are mining at the moment at our largest mining operation. We've seen some short-term production impacts in the first half, but we fixed those and we should bring it back in the second half.
Indeed, it seems the market wasn't worried about the performance of the company, at least in this interim, because it is reflected in the share price actually going up. But let's talk about the growth in half-year capital expenditure, which is predominantly linked to the future of the Mogalakwena mine.
I think, Xolani, there's a couple of capital factors that we need to consider. Firstly, I want to talk about our disciplined capital allocation framework. We are very clear on how we take decisions around any capital spent. Firstly, our stay-in business and life extension capital go through a rigorous process of understanding the life cycles of our assets, the maintenance strategy on how we maintain, and the stay-in business capital that we need to spend to maintain the assets. And I think it's important to remember world-class mining assets, integrated processing portfolio our processing portfolio needs to match the life expectancy of our mines, and therefore how we maintain those assets is really important. So once we've considered that and we have a very clear way of doing trade-offs on the stay-in business capital and also how we spend money on LifeX, we then will take decisions on whether we grow our portfolio or whether we give money back to our investors. And therefore we've got a very clear policy of a minimum of 40% dividend of headline earnings. And I think important to probably just comment at this point that dollar for dollar we have matched every dollar we've spent on capital, we've matched with returns to our shareholders in the last decade. So I think we've showcased and we've proven that our disciplined capital allocation framework works. It maintains our business whilst ensuring that return value to our shareholders.
Natascha, something interesting here is that you've kept your guidance unchanged for the rest of the year with anything between 3.6 to 4 million ounces. But a lot of this seems to rest on the frequency and the impact of load curtailment from Eskom, as we've seen the stages of load shedding for the rest of the country being ratcheted up. This rests with load curtailment in as far as you being able to meet this guidance.
Xolani, we have built some of that in, and you would have seen that in the first half, we have built stock of about 66,000 ounces on the back of curtailment. Now, I'm really glad that you differentiate between curtailment and load shedding. As an intensive energy user, we form part of a group that gets curtailed because our consumption also forms a base load for Eskom. And then in addition, Eskom will tell us how much they need us to cut back. And we have optionality on where we cut back on our consumption. We have a very strict and well-proven profile on how we do that, protecting our base operations, mainly our mining operations, building in stock predominantly in ore stocks and concentrate, because our highest intensity portions of our business do have catch-up capacity. So we'll see whilst we are putting the performance out there, always depending on what load curtailment will bring our way, we see that it will predominantly be built in work in progress and not necessarily lost ounces. And that work in progress will be able to filter through. So I think a well-established process of how we mitigate against load curtailment.
Natascha, how do you see the outlook for PGMs for the rest of the year in terms of commodity prices? Because we've seen a drastic change over the past 24 months.
Different metals was impacted differently over the last 24 months. We have seen primary supply and secondary supply playing a role in the forecast of the either surplus or deficit in metals. We've definitely seen our demand sector in light vehicle production, for instance, ahead of expectation. We're predicting a 4% increase in ICE vehicle growth specifically, which our product is predominantly used in, so an important demand sector. From a secondary supply point of view, rhodium price specifically was impacted quite a bit by the fiberglass industry that has expanded too much in response to decarbonization, because fiberglass used in wind turbines for renewable energy. And as the rhodium price went really high, we saw them substituting rhodium, sacrificing process efficiency and as an offset to cost of rhodium. And that's why I say, whilst it's really good to have those spurts of high prices, they're really not sustainable. We see some of that rhodium come back into the market over the last 12 months, but we also see that that's depleting. So as we look forward with that secondary supply now better under control, with light duty vehicles coming back and forecasting a 4% improvement or increase in supply, we do see our metals being more in balance for the remainder of the year. And Xolani, I will not be doing my job if I don't talk about the hydrogen economy. It is really an exciting environment for us, because as we see electric vehicles starting to take a portion of our market, we forget often that fuel cell electric vehicles is also an electric vehicle, an electric vehicle that's far less mineral intense, far greener, in other words. And with legislation like the Inflation Reduction Act in the US, we see green hydrogen production, the cost of green hydrogen production really plummeting, to use your words earlier, getting it into parity, and now making end use of technologies very available in the market far more interesting. So as we see ICE stronger for longer, probably battery electric vehicles, the rate of penetration slowing down, we see a significant momentum in hydrogen and fuel cell electric vehicles. That is quite an exciting environment for our metals.
An exciting time indeed, as the market is also excited about over 1,000 hydrogen projects globally that have been launched going into the year 2030. An exciting time indeed. Natascha Viljoen is the CEO at Anglo American Platinum. Thank you very much for your time this afternoon.